Okay, we are live. We were just talking backstage around options trading and what we were doing.
Yeah, basically, I have a hack. The reason why I've been successful in the market mostly is I figure out where Tevis sold his covered calls, and I know just to buy those same covered calls, and I'm gonna just make out great. So
Yeah, man. Some people. I remember when I was in Mexico on stream, I sold 105 covered calls on Robinhood, and the next day people were tagging me,
is
being
Tevis
like,
frozen up to you guys at all, or is it just me?
I don't know if it's me or if it's you, Roy.
I can see you now. Weird. I don't know which one of us that was. So I guess let us know in the comments, guys, if you don't mind. Good on. Okay, I guess we're both working. It's probably me then.
Yeah, I was just saying in Mexico, like somebody tagged me on Robinhood. He was saying like, "Oh, well, you wrote covered calls 105," and I would like to let everybody know that those did not hit, and I closed those off at 90% profit. So it's not a 1-to-1. It's just very highly correlated. I think Roy's the one that's having the issues.
Yeah, I heard. I think Roy is the one having issues and nothing else. So, but exactly whatever you said, 100% right. Hopefully, let me leave studio and come back. Just that resets it. I'll be right back, guys.
Will we be discussing hymns today, Charlie? I wrote some hymns. Cash. I have a lot of hymns. Cash secured puts. Actually, it's like the main thing that I'm writing on right now. And the thing is so freaking volatile, man, that it just makes sense. Like I closed off the puts that I opened yesterday. I closed them off today at like 75% profit. It just the thing is so volatile, and like I don't mind owning the underlying shares, so I'm happy either way. Like if I got put HIMS shares right now at, $41, $42, like which would be my break even, I wouldn't really complain about it. I would just start to, go even lower. So it's just like the perfect company for me at this time to write on.
Yeah, I'm sold. I still have shares. Basically, the way I've done with HIMS is I have a core position that's my HIMS shares that I don't really want to get rid of at all. I'll roll those if it goes past a covered call strike. I'll hold on to those. Sometimes I won't even write calls. And then the trading position, although it's a little bit larger these days just because of the risk from Novo Nordisk, I think potentially suing HIMS. We'll see if that actually turns into something or not. I think short term there's some risk, but I'm writing cash secured puts at strikes that I'm comfortable with filling. I sold at a higher level anyway, and it's not for the full size of position. Basically, if HIMS goes down to 40, I'll have more shares. If it goes down to 35, I'll have more shares there. If it goes down to like $30 or $25, that's silly, and that's where I get really excited because I will be buying a lot.
Yeah, I mean, I saw David ask, what are the premiums on HIMS puts? Like I wrote, and you can let me know if this is a good call or a bad call, Roy, but I wrote $45 puts for HIMS for September 19th, and it was $7 in premium.
Yeah. I mean, like if as long as the thing is with cash secured puts, as long as that's money that you can afford to have invested in the market for the next 5 years, and it's in a position that you like and a strike you like, the downside is really limited. There's always downside of like, oh man, what if really bad news happens and then like HIMS is trading at $20? Yes, but that's for literally any stock out there, whether you have a position or you wrote cash secured puts. So in my mind, anyway, that's the way I approach it. Is I'll never write cash secured puts on stocks I don't want to own, and I won't write them at strikes I'm not comfortable owning at. But if I'm like, hey, I wouldn't mind buying if it gets there, why don't I just write cash secured puts? Somebody actually asked me today, and I'm not giving financial advice, but he was like, hey, do you think SOFI will retrace to $18? I'd like to get back in at 18. I'm like, if you're comfortable with options and make sure you're comfortable and you know what you're doing, why not just write cash secured puts at 18? I mean, the worst that's going to happen is you will get the premium. The best is you get your shares.
Yeah. And those are the best ones to write. Like, I have zero fear writing on stocks that I just fundamentally want to own. And it kind of is not worth the time for SoFi to some degree. I mean, it will be once the stock actually like goes into the 20s and higher, because the premiums are going to be better. But Hims is perfect, man, because it's a company that I want to own, and I'm perfectly fine to own it, in the low 40s, high 30s, that kind of range. I already have a massive position in like the low 20s. And then Tesla is the other one where like it's kind of distressed or struggling, but that's one that I don't really want to touch right now. I don't like, I want to be reducing my position in Tesla as opposed to adding to my position in Tesla, just because my confidence in Tesla right now is not as high as my confidence is in Hims, regardless of the lawsuit.
Let's maybe start there then with Tesla. And we've got kind of a hodgepodge episode, guys, a lot of different topics out there. As always, as we get towards the end of today's show, we'll take your guys' questions. We'll take some along the way, but we'll save a lot of those to the end for rapid fire mode.
And yeah,
so,
I am bookmarking. We will talk about SoFi. We will talk about Webull potentially.
and DD's question on Lulu.
Lulu, I got that question. Yeah, welcome, Stock Goat. We're here. The whole SoFi crew is here.
Congratulations, Stock Goat and other SoFi shareholders. It for a lot of us, this is probably the highest we've ever seen. Because honestly, most SoFi investors were not those that bought into the Chamath hype and the pump and dump of that SPAC. But instead, we saw quality. Perhaps when SoFi was falling to 14, it's like, oh man, let me get in this. Or when it was down in the 4s and 5s. So it feels good. It's nice that the market's actually rewarding what SoFi has been doing. I mean, they've made mistakes along the way. It's not a perfect company, but it was a great setup. And it was a reason why, going back to the bootleg draft 2 weeks ago, Tevis somehow engineered it so that he got the first overall pick. And literally 4 out of 5 of us would have taken SoFi as a first overall pick. Tevis, that should have been our signal to buy more SoFi. What do you think?
I mean, I'm underperforming all of you guys. Well, I'm underperforming Roy, and he had Hims as his number one choice. So I don't know, man.
Well, it's just because I'm a superior stock picker. So over 2 weeks, am I still the best of humanity right now,
dude? Can you can we just what the heck is going on?
Yeah, no.
That GPT and Gemini are smoking us, and they got the bottom of the barrel. Like last picks out of everybody in this. Like, should we just give up and let AI do all of our investing for us?
So literally, ChatGPT might beat us. Like it might. Its picks were not bad. Like I think all of us were surprised when this was done. And just to give you guys a framework, it's a great video. It's worth watching too. The setup of this. We all went snake draft style, fantasy draft style. These are not stocks we actually own, but we're looking at performance over the next 12 months. So there's stocks on there that I do not own, actually, a lot of them, where I'm like, these are good opportunities, narrative driven over the next 12 months. I picked it. There's only one pick on there that I actually regret out of all mine. But I picked trying to go for a second place, if that makes sense. First place, I think, takes a lot more risk than I was like, hey, let me pick second place. Maybe things will blow up. Gemini went like full port degen mode. And so like Plug is up 20%. DraftKings is up 15%. Ionic is up. I actually have a put position on Ionic. And Neo. I mean, like, look at that. But ChatGPT, I was like, dude, these are the dregs. And I don't really like Apple there, but I mean, like, overall, it's not bad. So I was pretty impressed. We might be in trouble.
Can I show you something that you have to promise you can't show Tanner? Because you almost picked this stock as a joke, but in fact, you would actually be way up because this thing's up 41% in your thing. Well, so everybody watching, nobody tell Tanner, okay? Nobody tell him.
So legitimately, it wasn't really a joke. I was thinking of picking it, yes, for the memes, mostly. But I was looking at Joby, Momentum, what they're building, the partnerships that they're launching. I'm not invested in it. I did release a video where I'm like, horizontal scaling is easier than vertical, but if vertical goes well, I mean, you're positioned incredibly. And Joby has great engineering. I gave him props for that. I was hard on them when Tanner made the pick because I didn't know the company. But following a little bit more closely what they do, I don't know that they'll make it. I don't want to bet on eVTOLs, but I was willing to take that. If Axon wasn't there, Joby was one of like a couple of companies where I'm like, hey, I would love to take this here. So yeah.
All right. What's our first topic of the night?
Tesla.
Yes. Oh, man.
So you're looking to reduce your position. It's because you're a paper hander. Is that it?
No, man. It's because this mofo is like, honestly, he's perfect for swing traders and he's perfect for option sellers because I can sell covered calls and sleep like a baby knowing that he cannot resist the temptation to post some political shit for more than a week. He can't like stay put for a week because he said, I'm leaving politics to focus on Tesla. Stock gets a pump. And then he says some crazy shit critiquing, Trump and then these bills and the spending. And then he's like, okay, screw it. I'm starting my own party. And he did all of that in the course of like a month. So
yeah, America Party like that. I admire what he's doing, and he's right about the debt. But politics aside, well, I don't even want to go to the history of third parties. But yeah, if you're not familiar with how third parties can what they can do, look at the election of 1914 when we got our worst president in American history ever. No president will be worse because of a third party run. Anyway, beyond that, and I do admire what he's doing in that regard. It's the way he's approaching things, what he's saying, the Epstein files stuff. It's just a mess. And sometimes Elon is a hot mess, and it's like, hey, that's cool, that's fine. Right now, it's more of just a plain old mess, and I don't like it. I'm concerned as far as a shareholder. I reduced my position, even though the technology is there, vertical integration is there. I mean, robots are coming at some point, but the more you tick off large elements of your forward TAM, whether it's a vehicle side, whether it's to a lesser extent the energy sector, eventually bots as well, and robotaxis, I mean, that's just not great for shareholder value. That's not great for a company, even if it's for the right reason. So just purely from a shareholder standpoint, I'm not happy.
Yeah, I mean, look, I think, people were talking about opportunity cost a lot on SoFi when it was in $12, $11, whatever. I think Tesla, there is a valid argument to be made for opportunity cost. You might be saying, Tevis, you're crazy because this thing pumped to like $480. Yeah, if you were trying to time the market and trade in and out, you would have made a lot of money potentially because of the massive volatile swings. But if you were just holding, and now you tell me, hey, Tevis, like the real catalyst for Tesla when it's going to do another 5x or another 10x is going to be Optimus, which is coming in several years, then it's going to be some dead money until then, because what do we have to hold us over until then? Robotaxis? Like, I'm excited for robotaxi expansion nationwide, but robotaxis right now from a buzz perspective are completely overshadowed by the fact that now Elon's like so entrenched in politics. And like it was hot for like a weekend when they launched in Austin, and now it's like, okay, cool, they launched. They're not going to really reflect on the financials until probably I don't know, mid 26 to be very generous with you, but probably not until much later. And then the actual robots are not going to come until later still. And so at some point in time, there's going to be a big enough gap in between the narrative or in between the hype cycles that fundamentals are actually going to start mattering again to the retail. And I feel like the retail shareholder is exhausted. And you just look at the stock, it just struggles to go like, higher and higher. And it's just been trading in a holding pattern. So I don't know, man. It's tough to be a holder right now.
Yeah, and that's one of the reasons why I reduced my position greatly. I still do have shares. I would like to be in Tesla, and I would love to add if the stock actually dips. Now, people were looking at like 280, 290 as a dip. I'm like, for me, that's not a dip. Under 200, yeah, that's a dip. That's when I get excited. And I'm not the only big shareholder in Bull that it's not excited. Tevis, Tanner has exited Tesla entirely. Dan Ives, of course, noted Bull.
I laughed out loud at this today.
Yeah, and Brad Freeman, had comments on it, but Dan's plan was like, hey, new pay package, getting Musk to 25% of voting control, clearing the path for a XAI merger, which they've talked about before. No problem with that. That's fine. Guardrails established for an amount of time Musk spends at Tesla as part of the pay package and oversight on political endeavors. Brad Friedman says, hey, something tells me he doesn't love Dan's plan. We probably could have guessed it. Here is Elon's response. Cogent, as always, richest and probably the most powerful man in the world, doesn't really like being told how to spend his time and what he should be involved in. So not a big surprise.
I mean, it's not the first time he's been critical of analysts. Let's put it that way. First time I remember with Dan Ives, but he's definitely come down pretty hard on some analysts in the past.
Yeah, and honestly, though, I think the criticism is warranted. The shareholder, Elon, is still important. He should not be removed as the CEO of Tesla. People saying that, I don't know what they're thinking. Tesla does not trade on fundamentals. It doesn't. It trades on a narrative, and it trades on Elon, basically a narrative around Elon. Maybe not ideal, but I mean, that's the reality. If you remove Elon from the equation, guess what? It's a car company.
I mean, that's true until it's not anymore. Because it's like, yeah, sure, if you had Elon's undivided attention, then absolutely. But like, is Elon still Elon? Like, you get what I'm saying? Like, he's split in so many different directions that at some point in time, you have to ask yourself, would another, CEO who has 100% of their time dedicated to Tesla be more effective than 20% of Elon's attention, 15% of Elon's attention? At whatever point, it fluctuates. Now, and the reality might be it's, actually 75% of, Elon's attention is in Tesla, and the 25% is what you're seeing on X, but we don't know that to be the case, right? And so as his attention diminishes and gets distracted in different places, the mumblings are going to increase around, okay, do we need another actual person? Simply for the fact that they can dedicate 100% of their effort to that one cause.
Yep. One more topic, well, maybe more for you from Tesla. So the big, beautiful bill, so-called, passed. And as a result, the tax credit is ending. You have to have your order by September 30th. This is actually the worst scenario to all the plans that were forwarded. It actually very much surprises me that they're ending this before the end of the year. That's really rare with this kind of incentive. Usually it's end of the year type of thing, or perhaps the beginning of the next fiscal year. So it's odd. Over the short term, this is a massive demand lever that is thrown forward. So people that were thinking about buying a Tesla in the next year or two, they're going to buy it now if they qualify for this discount, just because, they can. It's a great car. They have the refresh. There's a lot of cars out there, and $7,500 is not a small amount to sneeze at. Beyond that, this is, in my opinion, we've talked about this before, but I'd like to hear a refresh of your take. I think this is really bearish Tesla. Yes, it's even harder on the other EV car makers, and so Tesla will capture more of that market. But the real competition, as I see it, is other ICE vehicles, and this hurts them in that. This does hurt Tesla. It's another thing that it's more than a car company, what they're building long term, but it's just another drag and another pain point.
Yeah, I mean, I think on principle, I agree with that. Like, it's a war of attrition, and Tesla has the biggest margin of safety from like a margins perspective when compared to like legacy automakers, right? So I think that, I mean, Elon's stance has been pretty clear on the fact that they're not really super desperate on credits. I won't go so far as to say as credits doesn't, do anything for demand. Of course, credits helps demand because more people can be eligible to purchase those. Like it's within their income bracket. But yeah, it hurts everybody, but it hurts others disproportionately. And so if you want to say, hey, that's actually a benefit to Tesla because others are going to be hurt disproportionate to them, then yeah, you go right ahead and do that. But it's also going to hurt Tesla, right? To a much lesser degree.
Yeah. And they'll be fine. I mean, they have a massive cash pile. They still are EPS profitable. There may be a time, not in the next couple quarters, but perhaps more likely quarter one of next year, where they might actually slip below profitability for a little while. But we'll have to see how that actually plays out. It's not the end of the world. Tesla won't be dead at that point, but it actually may prove to be a compelling entry for those that are wanting to either enter or build a long-term position or add to. So I guess my question to you, Tevis, you're looking, to reduce your position, not add more. But at what point, as far as price point, or if there's key things that you're looking at from the fundamental company, would you consider adding to your position?
I think there's two things really, and neither of them are price point, right? Like if Tesla were to go to 350 versus 250, I don't think that would be like, a massive like pounding the table kind of move for me to add more. I think the two things for me are improving fundamentals, so margins, the actual growth of the company that's stagnated over the last 6 quarters, them actually hitting their target. God forbid they hit a target for once, because I think like what 6 out of the last 7 earnings they've missed. And then, so that's the first thing, is an improvement in fundamentals, which I think will come towards the next couple of years. At least that's what management has guided for. But I don't know how much of that is like, pumping the stock versus actual promises. And then the second thing is a renewed focus in Elon. So we know from the Isaacson biography, the Vance biography, like I've read them both. And basically, whenever he sort of sways too far away from Tesla, he'll always come back and he'll make some key changes in management, and then he'll be like super focused, hardcore mode again. Like I want to see that, and I haven't really seen it so far back as like I think the acquisition of Twitter was the start of that whole spiral. And I think again, not looking at any of the stock charts, I can't remember the prices off the top of my head, but like if you had sold all your Tesla shares at some point in time before, like when the Twitter acquisition was announced, uh, you would have done probably much better when you take into account the amount of time and the movement in the price. Yes, you could have traded in and out and done very, very well for yourself because, like I said, it's volatile. But but the time cost, that opportunity cost of your time, uh, I think is very closely correlated with Elon's distractions of him being elsewhere in focus. So that's the second thing, is like I need him to be back in Tesla, and I just think that like I mean I've been at that point, and like I've been at a job for way too long, and like I just don't feel it anymore. I don't have that honeymoon period.
Yeah. Yeah. And same, like there's more risk the higher the stock price is. So building on what you said, if Optimus really does begin to scale or robo taxis really begin to take off, probably that'll get priced in before I end up buying. But otherwise, if it falls under $200, I'll start adding there a little bit more slowly as it goes further down. And it may not go to $200. It may not. I realize that. I'm fine with it. But we'll have to see. It's tough with this is a very different type of key man risk where he's an incredible performer. He's a one of a kind guy, a unicorn CEO, but he's not there half the time. And so it's kind of like being married to somebody who is just an amazing husband when he's around, but he's around less and less. And oftentimes he's doing things that you're like, is this really amazing? Is this really what's best for the family? You begin to question things. So, Tesla, next topic. What do you want to discuss, or do you want me to pitch the next one?
Yeah, no, I think you can jump into the next topic. I think SoFi needs to be a topic at some point.
Let's do that one then. I think the people are in demand of that. So, SoFi, why is it running, Tevis?
I mean, the run is long overdue, man. I don't think it should be a why is it running conversation. I think it's been, why hasn't it run so far?
Be honest. It's covered calls. Your covered calls.
Yeah, no, of course. Yeah, my covered calls. I think that the macro is just good in general. I think that really crypto announcement was almost like the spark that led to that SoFi run up. I should probably make a video. I might do that right after this live stream.
Yeah, really, there's and Nuno hinted at this at the beginning of the year. He said that out of the 7 years that he's been a CEO at SoFi, that this is the most favorable year. Then they got it the way they did, and I'm like, seriously? But I mean, they have notable conservative guidance for a reason. But there are tremendous headwinds that have shifted to tailwinds. One of those is, of course, a shift in the SEC. Some of that is allowing their crypto platform to come back by the end of the year. That is exciting. What they're building long term for crypto, I think, is exciting. I believe that they've hired their next CTO. I think Jeremy is probably out and out soon. At least I hope so as a shareholder. Tech platform has some headwinds still, but a lot of that's their largest customer rolling off. They have a lot of new customers that will build up into next year. But I think the bottom line of why it's running is it's been undervalued anyway for a long time. You're absolutely right. It's growing rapidly. It's profitable. Like the bear cases were just desperate and silly at times. And then looking at some shifts in the macro, we have rate cuts coming up. Rate cut expectations continue to actually decline recently through the end of the year. 2 to 3 rate cuts seem very likely, not in July, but in September. It looks like the first one. And I think there'll probably be 2, but maybe 3. We'll see. But I think the market is looking forward even beyond that with Jerome Powell, his term ending as a Fed chair in May. Traditionally, even though he has a longer term after that, he could serve on the board. Usually when the chair is done with their term, they leave. So that gives Trump 2 seats. And we all know what Trump wants as far as rate cuts. Did you see that tweet or I guess that post that Donald Trump put out? He was looking at a 1 to, I believe, 1.5% terminal rate, which is lower than anybody. Like, and I know this is probably a Trump negotiating tactic, but still, I think that would be probably actually better than where rates are. I think they're higher than they should be, but that's lower than they should be as well, and it could cause some problems. But for SoFi, it would be freaking amazing. So I think some of that's being priced in. And then the other factor is within the big, beautiful bill itself, there were some legislation changes that hit and impacted student loans. And the most significant really is relating to the cap limit for grad plus loans and also professional loans. I detailed this in my recent video. You guys can take a look. But in essence, there's going to be a higher demand for private loans. And guess who controls that market? Yep. SoFi. There's a lot of other student loan tailwinds too. But yeah, just so many things that have been a headwind for the longest time, all of a sudden are tailwinds. And this is a well-run company. It's not as aggressive as Robinhood. It's not as stable as some, but it was undervalued. That's why we're pounding the table on it. So congratulations, fellow shareholders. But bottom line is the main reason why it's running is Tevis's covered calls.
Yeah, I mean, it's up 41% in the past month. So I think the thing can definitely run quite a bit. And it's crazy, man. Like, you guys were all here watching when I made a bet with Matt, a $500 bet that this thing was going to close the year at $25. And back then it was like $12, $13 a share. And that bet's not looking so crazy now. But like, I think it's going to trade sideways for a little while, even though we know that it runs into earnings. I think $20 is going to be a big psychological level to break. And we'll see where it goes from there. But I think that once it breaks into the 20s, sustainably so, off the back of not only student loans, but also the loan platform business, which is accelerating, then you're going to see some new all-time highs, and we could even see them as early as this year. Like, keep in mind, we're only halfway through the year right now.
Yeah, 28.50 something.
Like 28.50, yeah.
Yeah. There's a decent chance if macro remains intact that we see that. I'm not betting on that. Again, my price target by the end of the year was 25, which looked ridiculous at times. I think yours was right around there too. Actually, all of us were pretty much in lockstep. Loan platform business is a big part of that too. But yeah, we'll have to see. It's a good setup in earnings too. SoFi does usually run in earnings. It usually does pull back in earnings, not always though. What's going to be interesting is to see how it performs with that really weak, actually, year-over-year comp. Let me pull that up, actually. That I think a lot of our folks may not realize how nice this is. You never really like to have a weak quarter, but the nice thing is the next year, as long as you're a well-executed company, you are positioned very well for that year-over-year comp. So let me throw this up here. Do you notice any quarter that just seems out of step? It's the one that we get to compare ourselves to this time. So, the rest of it, and there's a reason for that. But this quarter is going to look very good on the year-over-year revenue comps. EPS because it's a small number, but that I don't know. I think the one thing I'll say, there'll always be pumpers and traders and people that get too excited, like, oh man, 44%, they've not been paying attention. Maybe it won't be that high. But the one thing that I'll say, which is actually a huge positive for SoFi, well, I guess two, is with the stock running, there are people that are looking at SoFi for the first time as a credible business that maybe they looked at it 3 years ago when it was like, it's okay. And they say, oh man, this is actually a really good company. Maybe I should get in. And second, there's going to be people that look at this stock for the first time after quarter two earnings. When they post whatever they post, it's going to be strong with this really weak comp, making it look even stronger to be like, okay, SoFi is growing at, let's say, 40% year over year. Why am I not in this company? Mm-hmm. And it's a silly reason, but sometimes it just takes one little thing to get extra eyeballs on the stock, and then people, or not the stock, but the company, and they actually see it for what it is. That's the main thing of what's happening with the market. Like if you think about what is fundamentally changed with SoFi, I mean, there have been shifts in macro, legitimate shifts that do impact the business, but the biggest thing is the narrative. Stocks over the short term trade over the narrative, and the narrative is very rosy right now. So yeah, it's a good thing.
Yeah, and again, like with the macro where it is, and if Powell is not in his seat in the next few years, like this market's going to continue to pump. We'll see what happens between now and then. If there is some other geopolitics, because that always shakes the market. But generally speaking, like it is very euphoric out there. But SoFi is not one of those names that is traditionally like very richly valued. And so I think it can definitely catch a bid in that context, especially once it hits some of the screeners, because it's achieved, some prices that are maybe all-time highs or even prices that it hasn't hit in like the last 4 years.
And that lending club pair trade with SoFi, which was stupid at the time. I hope people lose their jobs over it. Like,
I mean, he's not even there anymore, dude.
Yeah, I mean, like, I know, but like where he's at, they should look at that and be like, dude, you're an idiot. You should be fired. It makes no sense in an area that is very cyclical. Like this is like, just using another example that I don't think our people are emotionally attached to, Solar Edge and Enphase. Incredibly cyclical industry, incredibly so. Why would you pair trade those?
Yeah.
And they compete in like a small area, but it makes no sense. If one does well, the other is going to do really well as well. They're not really taking market share from each other. It's taking market share from other people. If the cycle is great, you've limited your upside. If it's bad, you've killed yourself. So it made no logical sense, even if you're a bearish SoFi. If you're bearish SoFi, just short them, which was stupid too. But yeah.
One other thing to keep in mind is that management's performance stock units are coming up. I think it's June 2026. Yep. So that's also something that they have to build towards, because I think it's a weighted average over the preceding 3 months.
I pulled it up, and correct me if wrong. We need to actually look at this relatively soon because it's very important for shareholders to know. 25, 35, and 45 for the C-suite, in essence. Of course, the largest goes to Noto, then Crystal Point. Jeremy Rochelle does get some, and there's others. But ultimately, it has to hold the share price as far as a weighted average for 30 days. I don't remember if that 30 days is before, after, or where that is. I could be wrong. We need to look again. I just looked at it this last week, though. So
okay, so it's 30 days instead of 90?
I believe so, yes. Which, the great thing is, and I love that they put that vehicle in there, because some companies don't, or at least didn't in the past, and the stock price would pump, and then it would come back down. It's like, well, we triggered it, so it doesn't matter. It's like, it matters for us shareholders because we're not trying to time the exit. But if it holds above that weighted average for 30 days, that's a great thing for shareholders. As a shareholder, I hope they get the 45s. More dilution, yes, but I mean, just look at what that would mean for your portfolios out there. So I don't think though that they get to 45. Maybe we'll talk about this on our FinTech Friday in the next few weeks. But 35s, I think there's a decent chance. 25s, they're going to get.
Yeah. Yeah, I think 25 still definitely get, but I think they're going to push to get the higher tranches. Now, of course, they can always push it out and renegotiate and just give themselves some more time. But yeah, with the stock price that gets closer, like I think that's a more motivating thing. With the stock price so far away from $45, it can almost be demotivating to say that, well, it's not going to 4x in a year. So like, why even try for this, highest tranche? But if it's at, $25 or $30 to get to 45, like they can artificially probably pump it there with some news strategically placed or something to that effect.
Yeah. The bad thing is SoFi is not good at that.
They're not good at that.
They're great if they want, like sometimes they release like the most awesome stuff and they do it in a way that like maybe 1,200 people will notice, period. And it's like, what are you doing? And then they release like today. I don't know that we get, but they're like as this big breaking news thing, and there's lots of media and attention, and it's a nothing burger. I mean, it's private equity ETFs that already were out there as a product, and SoFi investors have access to it. It's not nothing, but it's so small and minimal compared to a lot of the stuff that SoFi's been cooking up. And I'm like, dude, do you not get? Like, are you trying to depress the price of your stock over the short term for some reason? I don't know.
Yeah, man. I mean, look at the quality of Robinhood's recent, the presentation in France around the tokenization aspect. And, Vlad whipped out a chalkboard and it was like a whole event. People were invited with a live audience. Like, it's just so much more care and like marketing perception went into that, like from a PR perspective, as to how they delivered that news versus, SoFi just releases a wait list for the crypto product. And then Anthony Noor just tweets saying like, oh, we're going to do, blockchain and stable coins and whatever. Here's a press release with one, quote from the CEO or whatever.
Hims is likewise almost to that same level. It doesn't have the polish or the panache of what Robinhood does yet, but they're very good at pumping their own stock, which they're using it as a vehicle for future acquisitions, mergers, that sort of thing. So and I don't mind that as a shareholder. Like, increase the price of the stock, I'm on board as long as it's legit. So SoFi is terrible at that, but that doesn't mean it's a terrible investment. It just means over the short term, I think even if they tried they're like, oh man, we're close, let's go ahead and release some big news and stuff to pump the stock.
Yeah.
They're bad at it. And they're going to like something that's actually amazing. They're going to kind of shelve or just like announce it, like not even announce it. It just shows up and people notice it. Mm-hmm. And then like what's actually not exciting to be like, look at this amazing thing. We're partnering with Circle for stable coins. It's like, okay. I mean,
yeah.
So related to fintech, I have a topic on Amazon, and then I wanted to talk a little bit of Cloudflare just to touch the tip of that iceberg, not to go into too much detail, and then we'll look at maybe audience questions unless you have something else as well.
Sure.
We
got to talk about Webull at some point too.
Ooh, yes. Yeah. Let's do that right after this Amazon one. Remind me of that. Sure. And maybe we'll save Cloudflare because I'm still, it's an interesting company, guys. I'm not invested in it, but that CEO is, I think, somebody special. I think the company is as well. Anyway, Prime Day. Did you do any shopping at Amazon, Tevis?
No.
This is why it's down 14%, guys.
Yeah.
When billionaires like Tevis end up not shopping, it kills the momentum of the company. Tevis, you've let down America. You've let down Amazon.
Billionaires like Tevis who need to wait for Prime Day to get a 20% discount on $30 headphones.
That's right. I don't know how many pairs you're buying, but yeah. So this headline was a little bit stupid. Amazon Prime Day used to be a day. Do you remember those days when it was actually a day?
Oh yeah, it was like a full holiday.
And then they made it 2, and then they kind of made it 2.5. You know how many days it is this time?
How many?
4 officially.
4 days?
And then you had over a week, if you're actually a Prime member, which is a lot of people that shop heavily on Amazon, including myself. So if you spread out what once was 1 day, and even last year was just more like 2.5 days, to 4 days, surprise, surprise, you're not comparing apples to apples anymore. It's down 14%. The funny thing is, Amazon was down a little bit less than 2%, and payment processing companies, especially buy now, pay later, there's some other reasons for those as well, pulling back. Robinhood shouldn't be in there, by the way. I don't know. But most of them, except for Adyen, got killed today off of news that I thought was a little strange anyway, but it's funny that Amazon's down less than these guys, even though Amazon does their own payment processing. Simply, I think most of it is just because people fear what once was a fear before, that the consumer is weak, that they're over leveraged, that perhaps the changing of student loans is going to put pressure on the consumer, and it will, or perhaps the changing of the FICO scores to incorporate buy now, pay later stuff will hurt as far as people being able to spend. It will. But yeah, this is just silly today.
I mean, it doesn't really help that Jeff Bezos is dumping shares on Prime Day. Why would you do that on Prime Day?
It's Jeff. Like, I'm just surprised he didn't sell it right at $200 like he used to, just to try to prevent it from going over. Individual companies as well that reported, I know this is a little bit hard to see, this is not the only one that's out there, are basically like, hey, this headline is actually wrong. We're seeing a whole lot of demand compared to what we saw last year. And I'm hearing the same from competitors, peers, and so forth. So I think over the course of this 4 days, first, I think it's a mistake. You kill your urgency if you do something like this. Prime Day becoming a couple days, fine. 4 days, all week. Prime month, I mean, like, what's next? So, but I think they'll be fine. And I don't think that this really signals consumer weakness. Consumers are going to keep spending until they can't, which is not great, but it's good for shareholders. So.
Yeah, I have some cash secured puts on Amazon, so we'll see if those hit. That was my insurance policy, where I was like, okay, well, if the market goes down, I'll be put Amazon shares. Well, I mean, I didn't do cash secured puts. I bought the shares. I did like synthetic. I bought the shares at market price, and then I did deep in the money covered calls. And so I said, if the market goes down, then I get some free Amazon shares out of it. But if the market doesn't, then I'll just keep the premium.
So that's what you did instead of shop, Prime Day. Is you're like, hey, I'm going to shop for Amazon on Prime Day. It is discounted. I will give you that. So
there's only so many headphones I can actually wear.
Ironically, I posted this too. I rarely do, but I'm actually buying headphones. So
are you?
Yeah, the Pixel Buds Pro 2, whatever. I have AirPods that are like 6 years old that they don't do active noise canceling anymore. They hold a charge for like 2 hours. That's it. They're not white anymore. I'll say that. That's super gross, I know. But so time for something new. I just bought a Tesla. I can't afford much, but Google Pixel's on sale from Amazon Prime. Yes. All right. Webull.
Yeah. Okay. So Webull, I don't know how many of you are caught up with the content that Roy and I have been making on Webull, but basically, Webull was an interesting one, man. Webull, I feel bad because I'm still excited about Webull, and I know I shouldn't. I sold out of my position. Let me start there, and I don't intend on getting back into my position, which kind of kills me because I'm still excited about the actual fundamentals of the company and the growth of the company and the prospects of the company and the roadmap of the company. It's all very exciting. But I just cannot reconcile with the fact that if this company is successful and has great prospects and it has a great runway for growth, why would they ever agree to partner with such a nefarious, scummy type of organization that has such a spotty record? I mean, it's not a spotty record. 98% of the partnerships they've done have ended in some type of bankruptcy, or the actual company's losing 99% of their value. So that's not spotty. That's downright horrible. And I can't reconcile those two things.
Yeah, not quite the same as you, but mostly like as far as the narrative and everything. There's a lot more risk here simply because they did that. They're either dumb, desperate, or distressed, and none of those are good for shareholders. I sold out of my vertical spreads completely. Small loss, not a huge deal. You probably made some money because you were in earlier than I was. Because you guys didn't tell me you were in Mexico. But anyway, I saw the thesis. You guys didn't just say, "Hey, buy this," and I bought it. I look at things. I was looking at it before, and I kind of forgot about it. The setup is great. The company is well positioned. As long as bull market and crypto markets remain intact, I think there's a lot of upside. But there might be things that we don't know. They went to market as a SPAC. They are a foreign holding technically, even though they're listed in the United States. And so there's just not been the same level of scrutiny as would have been in a traditional IPO. So as a shareholder, I already was like, well, I think it'll be fine. But nevertheless, I had my own. When this came out, I missed it. I wasn't looking at Yorktown and all that. And I saw the 2.5% hit, and I'm like, that's a little bit weird, but I mean, whatever. It's not a whatever. Who they partnered with, and that they're willing to give up the equity for no reason when they could have done a lot of other possible vehicles if they needed to be able to fund future acquisitions or whatever projects they're working on. Crypto was mentioned. So anyway, I did keep my shares. It's not a massive position for me. It's still a swing position, and I'm just selling covered calls against it aggressively. If it goes in the money, I'm fine with that. I'll kiss Webull goodbye. Is there a point where I get it back in the future? Maybe as a swing trade. But again, the setup that I was looking at was over the next 12 to 18 months, maybe a 2 to 2.5x. It wasn't looking at a Robinhood type of run. People looking at Webull like that are making a mistake. It's not the same quality of company. It's just not. Robinhood is absolutely elite. I don't know if they're quite a unicorn, but they are an incredible company. And the market actually sees it right now. That's why it's being priced the way it is. Webull is a solid company, maybe even a good company. I don't know. We'll have to see. But they're not positioned nearly as well. So upside, yes, but a lot more risk. And I'm like, okay, I am not weighted according to where that risk is in my portfolio. This swing position was a lot larger than I usually do for a swing. So I was happy taking a small loss and getting out.
Yeah, I think I might take another look at Webull at some point in the future, regardless of the Yorkville deal, simply because, like, yeah, I agree that they're not going to have, Robinhood type of innovation, obviously. Like the growth rate, you can just look at the chart to know that. I do like their international expansion, but the reason why it might be compelling to take another look at them at some point in time is if the stock falls, as is the trend with Yorkville partnerships, let's say, today is trading at $12 in, 3 months, even if it breaks that $10 floor and it starts trading at like $8, whatever, then it might get really compelling because they have a lot of cash on hand, 1.2 billion. I think they got another 200 something million from the warrants. So 1.5-ish billion. Let's say they have another 1 billion from Yorkville. That's 2.5 billion. Well, right now their market cap is only about 5 billion. And so if the stock actually takes a tumble and you see a $3 billion market cap and they have 2.5 billion in cash, then it might be like a cigar butt type of play. I don't know yet. But that's like the only circumstance that I would like take on that outsized risk of getting back into Webull, of course, as a trade.
And even then, it would not be like oh man, I'm going to go 10% of my portfolio there, because
No.
losing 10% of my portfolio would hurt. 1%, yeah, I could do 1 or 2%, maybe 3%. We'll see. And that may not happen. Like they may be fine. This might be legitimate. There might not be any problems. It's just weird, and I don't like weird in my investments. And when I have weird that I don't understand, I tend to reduce.
Yeah.
That's appropriate for me. You guys do you.
Yeah. It's just, it also kind of sucks from like a content creation perspective, because we were talking about Webull around getting in, and here's the reason why. And then literally the news dropped like the next day, which also, I mean, I think that they could have had such a good thing with a lot of retail investors getting in because they were riding off of that Robinhood type of move. And for me, I don't really care that they raised money or that they have the option to raise more money. It's just the Yorkville Association is the only thing. Like if they had, done the warrants or had that warrants overhang, or if they, diluted or did something else, that would have almost been better because I know that they're not associated with some bad, shady reputation. And I know that the money is going to be used for business purposes that's going to accelerate their growth rate. So, it's just bad timing, weird timing almost. But it is what it is. We'll see how it plays out. It's still on my watch list. I mean, if it goes significantly down, then it's going to get interesting again. I don't really want to mess around with it though, even through like cash secured puts or anything like that, because I don't really want to own it. I wouldn't sleep easy at night. That's the only thing.
Yeah. Yeah, it is what it is. Frustrating. It's like, I think we're right, but less certain of that now just because the company is weird. But it seemed like a great opportunity. And I was like, man, why didn't I go in heavier? And now I'm like, I'm thankful that I didn't. I still went heavy. This is one other thing I thought we should talk about, which is like really big. This guy is the official title U.S. Director of Federal Housing. I was going to miss that. Pulte. He's sometimes wrong on takes and things. This is really interesting. And I'll admit that I don't understand mortgage backing at all. So, but previously, the way this worked is your rent payments, what you were actually doing. Let's say you had $1,400 in rent, and the housing payment is $2,000. Mortgage companies, when they were underwriting or they refused to underwrite you entirely, they did not take into account in terms of credit history any payments for rent. They just looked at credit cards and loans. This is huge. It's not the only solution necessary to really reaccelerate the housing market. Really, the 10-year yield has to fall, and Federal Reserve doesn't have much control of that at all. A little bit of impact from the Fed funds rate, but not much. So it's going to take more, but I thought that this was pretty interesting. And maybe it works differently in Canada. I'm not sure. But what this really does is gives a lot of people access to the housing market that may have not had access before.
Yeah. I mean, I think it's one of those no-brainer things that seems very long overdue. Like you're making a massive recurring payment on a monthly basis. It should obviously count towards your credit.
Yeah, that makes sense. Yeah, he even argued and said something to the effect of, if you're paying your rent on time, you're probably going to be paying your mortgage on time. So, I mean, it's not really any different.
Yeah, exactly.
52 minutes. Maybe we want to save the Cloudflare stuff for another time and just go right into questions if you have those. Or sure. I can just, if you're needing time for questions, I could just kind of comment on Cloudflare.
No, I can go into questions. We have plenty of questions.
Okay.
All right. B-dubs, do you think SoFi is setting up for a Hood or Palantir type run to triple digits? No. I think it's going to take much longer to do that type of run. I know Palantir and Hood seemingly went there like immediately.
So the reason why, or one of the reasons why, and actually Tom Lee had a great interview with Amit, which is worth watching, guys. Short, to the point. Learned some interesting things, interesting take on Tesla, on Ethereum as well, on several items. One of those, as that he mentioned, with Robinhood and also Palantir, and both are in his Granny Shots portfolio, I think, is basically looked at these as unicorns, one-of-a-kind companies that execute an incredibly high level. SoFi has differentiation. They're a good company. I don't know that they're on the same level, and I don't know that they can execute that way. So it's a little bit of an unfair world, but the reality is the stock market does not trade purely on fundamentals. Otherwise, we'd be in a very different reality. It trades very significantly on narratives, and the market is willing to overpay for perceived leaders and also for rarity. There's only one Robinhood. There are competitors. It's not that there's no competition at all. With Palantir, there's essentially no competition for what they do. There are products and there are areas and there are companies that do compete with certain aspects of what Palantir does. That's one of the reasons why Palantir trades at the ridiculous premium it does. And it is ridiculous. I'm not paying for it here. Robinhood gets a lot of that appreciation too. SoFi Still has, I think, a lot more upside over the next few years. But I would be surprised if it goes on a 10x from wherever it was in the next like 2 years. It's not going to do that. Maybe it does. If it does, that's amazing. I love it. We're also probably in a crazy, crazy bull market, and I'd be happy with that too. I guess we can buy a third Tesla. I don't know, but Tevis can buy, the state of Rhode Island, so become an American that way.
Yeah, that'd be I mean, I'll take one for the team, I guess. Webull, we talked about this. Roy, did you pick up Lulu yet?
Swing trade, yes. I have vertical spreads. I also have leaps, and those, I plan to hold for maybe a year, maybe a little bit longer. It's a shorter time target than Webull, also more conservative as far as a turnaround. And if it does well between now and Christmas, we'll have a very Lulu Christmas for my ladies. So my wife and my daughter, just in case somebody's reading into that.
Your harem of mistresses.
I realized I came out wrong. I'm like, oh no.
Can you discuss SOFX, the levered SOFI ETF? I've made some really good money with it. Do you want to go first, or do you want me to?
I don't like levered ETFs personally. I'd rather do options or nothing. There is a management fee for those. I like to manage my own money for the most part. I do have some that's managed. And I think a lot of people don't appreciate the downside risk. It's not just that it falls more at 2x compared to what you are. You can lose all your money. Shares, I don't know. Study options, and if you're comfortable with them, do that or do shares. I wouldn't mess around with this. But if you want to go pure degen, do this with options. But only if you're a pure degen. Don't do that probably. Small amount, unless you're Tevis. Small amount for him is like $2 million. So
I'm not buying the levered ETFs. I'm much more comfortable in options. And if you're uncomfortable, go far out of the money. Go far out in time and go as close as you can to at money for like calls, and you should be okay. Do you think SoFi will ever reach $100 like Hood? Yes.
It'll maybe 5 to 7 years. Which is really good. Don't think like, oh, a 5x from here in 5 to 7 years is terrible. Dude, that's amazing. Take that every single time.
Yeah. Do you think HIMS is better than Hood?
No. It's more volatile.
The stock or the company? I don't know what he's talking about.
Yeah, company, no, absolutely not. Robinhood is elite tier. HIMS, I think, is very good. Maybe even a little bit better than that. I wouldn't rate it the same tier. I mean, they just hired a CTO. We'll have to see how all that goes. There's a lot that's unknown there. Brought on somebody from Robinhood too. Take it from the best. As far as stock setup, like over the next 12 months, I would say yes. I took HIMS in the first round after all. But I'm also thinking that there's going to be a crypto winter. So factor that in.
Yeah. Roy, this one's for you. Why is the PayPal USD so disappointing?
Oh man, it's hard to make this succinct. They have there's two things going on. One is internal to PayPal, and it's their own fault, and I put the blame fully on them. And the other is external and partly perception. So internally, as far as PayPal, they launched PayUSD a month prior, or actually the same month as Alex Chris was hired as a CEO. So they did this in the typical Dan Schulman way, where they announce something, they release it, and they just kind of hope it works out without any cohesive plan at all. I don't know why Dan Schulman is a thing. So when you do that, and then you bring in a new CEO who realizes PayPal is a lot bigger mess than he was initially led to believe, myself as a shareholder also found that out the hard way. It's been painful. Your biggest thing that you have to do there is fight fires, correct the culture, get who you need and the team you need in the C-suite, identify critical issues that need to be improved now, which is margins, and also Braintree, the whole sales strategy. Honestly, the tech stack is a colossal mess. If I knew it at the time, if I knew then what I know now, of course, I would not have been an investor until I saw a turnaround. And I have seen that in the company, not so much the stock yet. Anyway, PayUSD, as far as a stablecoin integration, was probably pretty far down on that list, even though Alex is a noted crypto guy and crypto bull. He's been in crypto for a long time, and also AI, talking about both of those things before they were popular. So Once they cleaned up a big part of that mess, that's when the shift came to, okay, let's integrate this into our ecosystem. That integration has, even under Alex Chris, gone slower than I expected. And it's not, I would have liked to see them integrate this a little bit more. Some of that is regulation and regulatory concerns. Some of it is me not understanding some aspects of the crypto universe as well as I should have, a couple of years ago. I've got a better grasp of it now. Externally to them, though, so they've been slower than they should have been. They redeemed Zoom in essence, their international remittances, and they're. But I'd still would have liked to see them make a real big dent, specifically in that cross-border trade. It's vital. That's 10% of PayPal right there. It's the most lucrative, and they can sustain basically what they have there as far as margins if they use stablecoin with a lot of that portion. But they have to do it over the next, maybe 1 to 2 years because others are going after that. So externally to them, part of the perception of PayUSD being disappointing is this is not designed to be a Web3 token. Most stablecoin volume, the vast majority, 95, 98, maybe 99%, it is and has been used over the last 12 months or so, specifically for crypto applications. PayUSD can be used for that. Is it the best vehicle? I don't know. Probably not. What this token really is used for and most useful for is positioning it across the entire ecosystem of PayPal, saving them a lot in terms of margin, but also being used as a real-world token with real-world commerce, something that people have only recently begun talking about. PayPal, I think, still has a lead there. If this was Dan Schulman that was leading PayPal, I would give them no hope. Here, I'd say there's a 25% chance PayUSD really, really takes off. I also had an interesting idea related to this token and Cloudflare. Take a look on X. I don't know. This came to me like literally at midnight last night, Tevis, and I'm like, dude, this thing that Cloudflare is doing, which is like fascinating, it needs a stablecoin, and they admitted it. Cloudflare themselves are like, hey, we might launch our own stablecoin, and I'm like, just use PayPal, guys. PayPal, talk to these people, please.
Can you address this question? Because everybody's doing their own stable coins right now, and like it's gonna get to a place where like you have to be able to distinguish and determine between the stable coins that everybody else is offering. Otherwise, it's super commoditized. No,
it is a commodity. It's absolutely a commodity. Commodities, though, work as long as you have scale, and PayPal has scale, so they're absolutely fine. Circle. Coinbase, because they get like 70% of the amount of the revenue from that stable coin in their ecosystem. They're going to do great. Shopify as well. Stripe. The economies of scale just absolutely come into play. But as far as what stablecoin is, it's a one-for-one representation of something that is more tangible. I'd say, knowing fiat currency, it's not fully tangible, but that's a different story. So what happens with stablecoins? Digital dollars, I think you're referring to just like what you see in your bank account, that you're not literally seeing bills, but those actually are not one for one backed up the way it's done. So stable coins are actually less risky than bank dollars, which is really weird. FDI insurance aside. Anyway, so the stable coin has to be backed up on a one for one basis. There's questions of whether or not companies are actually doing that, but most are pretty well audited these days. Even Tether is less sketchy than they were, but boy, they're still sketchy. So the way this has to be done is through most stable coins. If the token that they represent is dollar, it has to be backed up by US dollars. These need to be, for the most part, 3-month treasury bills. So, and the reason why is if you have long-term treasuries and the rate changes, that's going to actually change the amount that your underlying holdings are worth. They're also not usually as liquid, and they don't roll off nearly as quickly. So, there's most stablecoins are again on the US dollar. There's some that are pegged to other assets. You could technically peg a token to like the Costco hot dog and drink mill, because that's a stable price. It'd be silly, but you can. There are some that are pegged to gold. Gold, even though the price is not stable, it's pegged that way. So the other thing with stablecoins is you have them, they move and operate across blockchains. And so you can usually use one token will launch on maybe Ethereum or Solana, and then we'll scale out to other blockchains as well. the reason why they're useful, digital dollars just represent, again, physical, real dollars, and they take time to be able to go from one account to another. And there's a lot of ledgers that have to be verified along the way. The nice thing about the blockchain itself, the way that this technology works, is a distributed ledger. So you don't have to have all those different entities in there making sure that everything is checked off, because the blockchain absolutely handles that and handles it very effectively and efficiently to the tune of near instant settlement. So instead of waiting for several days for this transaction to settle, it can be 4 or 5 days, even multiple weeks in international areas. Instead, if I'm sending it to Tevis, who's in a third world country, then all of a sudden, and I'm not saying that about Canada, I'm just saying if he goes to Zimbabwe or something and I send him something, it gets to him immediately and instantly. It's trackable as well because it's on the blockchain, and all those transactions are public in terms of the wallet number. And it's also programmable. So you can execute, in essence, smart contracts. So if I have Tevis render a service for me that he helps me with YouTube titles, and I pay him $5 million, which is chump change for him, but a lot for me, that contract can execute immediately as well. There's less friction along the way. It increases the velocity of money. There's a lot of benefits as far as adding to dollar dominance for the United States. The 3-month treasury bills, increasing demand for that, decreases rate, which is good as far as the massive debt problem that we have. It's not the whole solution, but it certainly does help. So there's a lot of benefits as well beyond that. But yeah, programmability and instant settlement are the two biggest ones, I would say. It's cheaper too in some respects, but not as cheap as most people say. Cross-border, yes. Actual transactions, you have to look at the other parties and the reason why they're in there. And so it's not a one-for-one. There's some great articles on that.
Nice. I think that's one of the better explanations that I've heard online. So thank you for that. Let's see. Let's take a couple of other questions and then we can wrap. Which one doubles first from current levels? SOFI to 40 or HIMS to 100, basically?
HIMS.
HIMS is my vote as well. I mean, HIMS at 100 is my price target for this year, and I think it's going to take SOFI much longer to get to 40. Maybe not much longer, but longer.
Yeah.
Are you guys still interested in Oscar?
Never was. I looked into it. When people I respect, pitch ideas, put it out there, I'll take a look because I'll miss some things otherwise. HIMS was one of those. Tevis pounded the table, and I'm like, okay, I'll listen. Oscar, I looked. It's in healthcare, specifically insurance. I don't like that field because basically the way that you make money is by denying claims. I mean, not exactly, and it's not entirely fair. There are businesses that are worse than others. I just don't like that feeling personally. It's also heavily regulated. I have a video comparing Oscar and HIMS. I think it's a decent company. It's probably going to be a good investment over the next 3.5 years, and I would get out before 4 years.
Yeah, I agree. Speaking of new companies, Shark Ninja. I know Tanner's big on this one. I saw a video with Joseph Carlson, I think it was, where he was talking about like how it's one of the most innovative companies and their product lineup is great. And I know they're public. I just haven't really looked into them as deeply as Tanner has. I believe the question here was that they're super overvalued.
Yes. They're the Costco of appliances.
Yeah. Take a look. Yeah, Shark Ninja. Wow. It's at $100 right now. They fell as low as $60 in April when the market as a whole fell. Shark Ninja will have a large hand in the go-to-market of AI and house robots. Interesting. Yeah, I don't know. I've never taken a look really at the financials. I don't own any of their products. I've never tried any of their products, but I mean, it could be interesting. They IPO'd in 2023, and they've done 4x since that time. So, yeah, that's pretty much all I know about Shark Ninja.
Yeah, it's one of those. It seems, from what I've heard, I don't own any either. that it's a good quality company. It'll probably go up over the long term. I think that a lot of companies will outperform it, but that doesn't make it a bad investment. It makes it a stable investment, which is not a bad thing.
Seems like a lot of people know their products, which
Yeah.
which is kind of interesting.
If I could just buy the shark and not the ninja, maybe, but I don't know.
Let's see what this nerd says. It doesn't need to be that deep. I own their products, spelled there wrong, of course.
Yeah.
They
I'm
are
not
better.
looking the rest because he did that.
Yeah, they're better than any other company. They are growing in market share. Market is somehow capitalized, but in every and it's not capitalized in the second time around. In every market they have entered, lots of geos to enter.
No,
Wow.
no punctuation. Nice.
Yeah.
Good job, Dan.
With insights like that, you must have 40,000 subs or something.
I mean, honestly, it's Peter Lynch style investing. Invest in what you know. Invest in what you know. There you go. But it's not a bad thing. Like it's one of the reasons why I'm in Lulu as a swing trade. And I shouldn't have missed this. I missed Duolingo simply because I wasn't in that frame of mindset when it came to investing. That if there's a product that my family gets very excited about, or relatives and friends, I need to at least take a look and see if they're publicly traded and what that setup looks like. Had I done that, Crocs would have been a nice trade for me. Duolingo likewise as well, and I missed those. Monster, that was back before I was doing individual investing, but we were buying, drinking, and enjoying Monsters very early into that run, and I didn't know anything about individual investing at that point. So, invest in what you know. You see quality. It's over the long term, that's a good setup, and it is a strong advantage that retail has, because a lot of people that are sitting in those big offices in New York, where they're drumming up these analyst reports, or working for these major funds, they are so divorced from the reality of a regular person that they have no idea what average consumers are loving and eating up. So we actually have first mover advantage there a lot of the times.
Would you buy HIMs and sell covered calls immediately, or sell cash secured puts? I'd probably do the cash secured puts, honestly.
Yeah, that's what I did today, literally.
Yeah, I have a lot of cash secured puts on HIMs, but I also have a long position, which I don't sell covered calls against, because I have learned my lesson, and I'm just too scared, quite frankly. Like, I'll get premium, but this thing's so volatile, it can go to 100 next week. I wouldn't even be surprised. We need our own energy drink. That is true.
We got the name. I mean, yeah.
Let's
do it.
I'm not drinking Celsius anymore on stream because they're not sponsoring me. So that's my quiet protest. But we can replace it with a bootleg drink.
And that's really what the market needs. Totally not a commodity. There's very few energy drinks out there. One more energy drink, but this one, the differentiation in the name, not so much. Flavor, certainly not. In the actual ingredients, no, not at all. But what we can do is every time you buy it, you get an NFT. So 2021 is back. It's actually not a terrible idea.
Sounds like a winning business model, Roy.
It's not a terrible idea. I'm actually kind of surprised that there's not like a Jones knockoff Jones Cola type thing that's doing that. I don't know if do you know Jones Cola? Is that a Canadian thing?
No, we don't have that up here.
So back in the late 90s, early 2000s, I'm ancient, yes. Jones did well, partly from ingredients, I think pure cane sugar, and they had interesting flavors, colorful bottles. But every single label, I believe, was different. It had different like random pictures that people submitted, and people loved that. It'd be kind of interesting if that became a thing just from NFTs. Yeah. Keeping up with the Joneses.
All right.
That's the name. Keeping up with the Joneses, the brand.
We're an hour and 13 minutes in. Shall we wrap there, or do you really want to talk about Cloudflare because somebody set you up for it?
Let me touch on it.
Okay. Go ahead.
I'll spend 5 minutes. Cut me off at 5 minutes. Okay, brother?
Sure.
All right. So a little bit of backdrop. There is a problem with the way that the internet is modeled right now. There's a lot of people commenting and talking about this. It's not just that search is dying. It's that the model that Google has built over the last 20 years and dominated is deteriorating because AI is accessing the web in a very different way than human eyeballs do. And so as a result, the advertising structure that underbeds the entire internet, it's under attack. There's issues just because if fewer and fewer people are actually looking at the ads and more AI is accessing it, and that's only going to accelerate, there's a problem, several structural problems. Now, this is not a complete solution, and there's a lot more nuance to that problem as well, which we won't get into in the interest of time. But in essence, Matthew Prince, the CEO of Cloudflare, which 20% of internet traffic actually runs through Cloudflare. I think it's 75% of Fortune 500 companies also run through Cloudflare. It's a massive cybersecurity firm, but it's more than that. It's kind of like the gatekeepers of the internet. So they have a great understanding of traffic. Matthew Prince has similar concerns. He has this great video, which I will not play any of, but just make this your next video. Don't click there yet. It is absolute gold for 17 minutes. Well, no, I'm not even going to start because then we'll just keep going. I'm tempted to play like the first minute, but phenomenal, ridiculous insight. So they see this problem. They have a lot of content creators where they see like, hey, this is a major drain on content creators. Not so much us, Tevis, but really those that are like the press, that are writing journal articles, that sort of thing. And so if AI can just scrape all your stuff and put it in Gemini Synopsis, which he has said some very livid things towards Google. It'll be interesting to see where that goes in the future. But it's not just Google that's a problem. It's really all of AI. There's an issue. All of a sudden, you as a content creator, you no longer have an interest in necessarily creating, because if you're doing it for fame, you're not getting famous. AI is just taking your content. If you're doing it for money, you're also not getting money unless you're in this walled garden of Google, which we are, YouTube. Thank you very much. So as a result, your drive to create is suddenly diminished, and then the internet dies a slow death. That's not a great thing. I should not have clicked away from this, so please bring this up again. In essence, what this does is it's a paper crawl. So every single time that there is a crawl across that page for AI specifically, then they end up charging for access. So they have tools like AI Audit already that they release for free for people, where they can look and see what's actually a real visit, what is not, what has been blocked because of the parameters that they set up as well related to AI. But this is really the framework of what they have launched in beta, that you have the AI crawler come and you actually have, whether it's blocked or not, or it allows through, they have certain bot solutions for that. You pick the rate that you charge. This is a microtransaction, so maybe like 4/10,000th of a cent, something very small, because AI is accessing a lot of content, and through probably ideally through stablecoin. Right now they're using actual current payment rails, which long term you can't do that. He did say, hey, we don't have to make money off this product. We just think it's the right thing to do. And then allows them to actually use or access that website content to scrape whatever the case is. You set up those parameters as well. And they made this model free. I don't think it goes into here all the different people they're partnering with, but it is a massive amount of very large media and advertising firms. These are not small guys, and there's a lot of people that are onboarding in this as well. It's going to change the model of the internet. It's very good I think, for a sustainable model for AI potentially. I don't know that it's the only solution that's out there. There was a similar solution that Microsoft was actually pitching a month ago, just because they saw a similar problem that the advertising model is with AI just going to go away. It's not a great thing, because we got to figure out what to do to still incentivize websites to exist and content to continue to be created. Otherwise, we are stagnant, and that's not great. So I just thought that was very interesting. They've done a whole lot that I'm not going to get into, not just on the front end, just saying, hey, have control of your own data, of your own website as it relates to AI. They're involved in model context protocol. They're actively involved in AI agents. They're doing a lot of very fascinating things there. They're actually not profitable, but there's some reasons for that, things that they're building out in the future. They're priced ridiculously high, not Palantir high, but as far as SaaS, I think that they're the number two, almost by whatever measure you look at. But a lot of it is what they're building, what they're lining up. He very much understands, Matthew Prince understands where the internet is going, what they need to do to preserve it, for the internet's sake and humanity's sake, but also for the company's sake as well. And I think it's fascinating. So again, look at that interview that I showed earlier. It's well worth 17 minutes of your time. Watch it in 2x if you don't think so. He's
So
fascinating. So I would love an entry in Cloudflare, but not at this valuation. It's one I've added to my watch list at the very top. Salivating to buy, but it's expensive. Yeah, I can post a link to the video. Let me do that here, guys.
isn't it always going to be expensive though, Roy? Like, at what point do you say valuation be damned? I have to be in this name.
Well, on valuation, let me pull up something right quick, and maybe we'll end with this.
Also, you posted a broken link, I think.
Okay, let me try that again.
Yeah, there you go.
All right, that's the link. And let me pull up. That's 18th. There's a more recent one. One sec. Here we go. Okay. So Hameen is well worth following if you're into SaaS at all, or if you're curious. Not just valuations, but he does a lot of that work as well. If we look at, this is the most recent article as far as valuation. He does one of these usually once a week. And Cloudflare is up there almost 30 times EV next 12 months. Let me look at the actual charts because they tell this story right here. This may be hard to see, but this is Palantir trading at 75 times enterprise value over the next 12 months. Cloudflare is at 30 times, and the median is 5.5. Now, some of these trade below that for a reason, and not all these are quality companies. Adobe is certainly under stress. Unity, things are not perfect there. 30 is pretty rich. It will be rich, but there's a point where it's like, okay, it's even too rich. There's one more chart here. An adjusted measure, growth adjusted enterprise value over the next 12 months of revenue. And we see Cloudflare again is a 1.2x. Median again is 0.5x as well. And there's a lot of quality companies. There's some that are not quality as well. Palo Alto is one of those that trades at more attractive multiples. That doesn't mean I wouldn't be willing to overpay for, this is actually one here too. Enterprise value over the next 12 months, free cash flow. So if you like the measure of free cash flow, I certainly do as well. There are some that are more expensive. Cloudflare is still, let's see, it's not as bad as CrowdStrike. I can't remember where it's at on this, and it's going to take too long to find. So where it was back in April, man, I would have loved to bought them, but everything had fallen. And I was just beginning to look at Cloudflare as a business. Actually, that was even before I started looking. So sometimes you don't realize, like, hey, I should look into this company in more detail. And just comments randomly from his last earnings call caught my eye, and I'm like, I got to learn more about this business and this guy. I think he's an incredible CEO. It's a great company that's done well. Is it the most exciting company out there? Well, no, but it's pretty exciting what they're building and doing. And I like the mission too. It's easier for me to personally invest and hold something that's maybe a little bit overpriced if I think there's upside, and also I like the mission.
Yeah, I mean, it's always going to trade richly valued. I don't think you're ever going to find that at a place where it is even near that, median line. So it's just a matter, it's similar with, any of these massive, like the Amazons and the Googles of the world. Like, if you want them, you just get in at whatever they're trading at, and then you can just average down if that's the case. I remember with Cloudflare, was it 3 weeks ago, they had an outage and the stock fell, and in retrospect, that might have been the perfect time.
Well, you would think that, but if you look at the actual share price, it didn't fall. At that point, I was talking with somebody actually last night, Sam Solid. He is a Cloudflare bull. I've read a lot of his posts. I'm like, dude, how did I miss these? But I told him, like, during that moment, I'm like, okay, is this the moment that I become a Cloudflare shareholder? And it didn't drop at all. Like, they were like, yeah, no big deal. It's like, freaking drop already. Like, come on.
All right. Shall we wrap there? About an hour and a half live stream.
Yeah, sounds good.
Maybe we can wrap with this. Rate this person's portfolio for the next 3 years from 1 to 5. I'm assuming 5 is the best. AMD, Amazon, Transmedics, SOFI, Hood.
I mean, I don't really know transmedics. I looked at it a while ago and I'm like, I don't know anything about the organ transplant business. And it's kind of a logistics business play as well. The stock has done well, but like long term, I don't know.
I'll give them
AMD,
more.
so I would say a 3 overall. I mean, it's not bad. Hood is fine, but over the next 3 years, I think we for sure hit a crypto winter. SoFi is well positioned with a lot of upside. AMD, I think, is okay. Like it's looks expensive to me personally. I think Lisa Su is very good as a CEO, but it's not the same tier and quality as Nvidia at all. Doesn't have to be. And Amazon, it's a good company, but it's not going to outperform massively. So I think it'll be solid. 3.
Yeah. Yeah. Okay. Tanner says good timing because I think his show is going to start now. So you guys can go watch that.
And then after that, watch the interview, and then after that, watch Amit's interview with Tom Lee. So you got your night planned for you.
And I'm going to go record a SoFi video because the lights and the cameras are already set up, so I might as well. And so after that, you can also watch that video. Thank you, everybody, for watching Bootleg Weekly. We'll see you again next week. And that's it. Have a good week. Bye.
That's it. Oh, my goodness, man.